Good.
All right, so we're gonna work the problems from chapter 20. So we're gonna start with exercise 20-7. And I wrote down the slide numbers and I forgot to bring that piece of paper in here with me. So, but that's okay. This is the high-low method. So that's what you need to look for on your slides. And I forgot the pages that it's covered too. So Ziegler Incorporated has decided to use the high-low method to estimate the total cost and the fixed and variable cost component of the total cost. The data for various levels of production are as follows. And this is on page, let's write that down, page 1033 of your book. So when you're using the high-low method, you look at the units produced and find the lowest and the highest. And so your formula to get the variable cost per unit is difference in total cost divided by difference in units produced. So in this problem, and once again, we're only talking about 2 points. We're talking about the highest and the lowest. So if we look at our units produced, the highest one was 120,000, the lowest one 80,000. So that's going to be our denominator. And then our difference in total cost, the cost associated with the 120,000, 32,120,000. And the cost associated with the lowest level, 25,100,000. So you end up with 7,020,000 divided by 40,000 units. So your variable cost for this company is $175. $175.50 per unit. Okay, and then the other thing it asked us to do was get the fixed cost. So to get the fixed cost, once you found the variable, you plug it in. Remember, your total cost is going to equal variable cost per unit times units produced plus fixed cost. So we know our total cost. We now have the information to get this portion, and then we can solve for our fixed cost. So you can plug it in. You have to use either the highest point or the lowest point. Don't use another data point. So we'll just plug it into the highest level. You'll get the same answer whether you plug it into the highest or the lowest. So we know our total cost for the highest was this 32,120,000. Our variable cost per unit that we just solved for, 175.50 times at the highest level, the 120,000 units. And then plus our fixed cost. So we get 32,120,000 equals 21,060,000 plus fixed cost. And of course, we just subtract the 21,060,000 from both sides, and we end up with fixed cost equals 11,060,000. And then one last thing it asks us to do. So now that we've got this, based on Part A and Part B actually to get, or I'm sorry, that's all Part A. Based on Part A, estimate the total cost for 115,000 units of production. So we ought to be able to say our total cost, like we just said up there, using that same formula. So we're solving for total cost this time. So our variable cost per unit would be the $175.50 times, this time we're estimating for 115,000 units, plus our fixed cost, which we now know is 11,060,000. So we have total cost equals 20,182,500 for our variable portion, plus 11,060,000 for our fixed portion. So our total estimated cost for 115,000 units would be $31,242,500. All right, we're going to work one more. You got it all?
Mm-hmm.
We're going to work 20-3B. And this has to do with a variable costing absorption income statement versus an absorption costing income statement. No, I'm sorry, wrong chapter. This has to do with break-even point. I'm jumping ahead to chapter 21. Sorry about that. This is on page 1041. This has to do actually with break-even point and target profit. So for the coming year, Coil Peeper Products Incorporated anticipates a unit selling price, a unit variable cost of 110 and fixed cost of 800,000. So the first thing it asks us to do is compute the anticipated break-even sales. I think it says in units. So our formula for break-even is total fixed cost divided by unit contribution margin. So it gives us the fixed cost is 800,000. We have to find our unit contribution margin. So remember, our unit contribution margin, to get unit contribution margin, it's your unit selling price, which is $150. Unit variable cost, which is 110. So our unit contribution margin is $40. So that's what we'll use over here. So to break even, oops, not dollars. To break even, they have to sell 20,000 units. Okay. The next question asks, what about their target profit? Of course, most companies don't want to break even; they want to make a profit. So what do we do to calculate target profit? Well, it's a very similar formula. So you have target profit equals, or sales for target profit, I should say, total fixed cost, and this time plus target profit. Once again, divided by unit contribution margin. So we know our fixed costs are 800 $1,000. It says that they want to make a target profit of $300,000. And we know our unit contribution margin is still $40. So we're going to end up with 1.1 million divided by $40. So we're going to have to sell to reach our target profit 27,500 units. Okay? And then part 3 of this problem, in the book it asks you to draw a graph. On Cengage it asks you to do something different, so we're not actually going to draw the graph. On Cengage it's going to give you some different dollar and unit amounts and ask you if it's a loss or a profit at those levels. So if it gives it to you in units, of course, anything above 20,000 units is where they break even. So anything above 20,000 unit sales is going to be a profit. Anything below that is going to be a loss. If they give you 20,000, of course, it's break even. If they give it to you in dollars, so 20,000 times $150, that's I don't have my calculator because Jamie's taping me. So is it 300,000? I'm not sure I put enough zeros in.
3 million.
3 million. I didn't put enough zeros. So if it gives you a dollar amount above 3 million, it's going to be a profit. Below that, it's going to be a loss. Okay, so that's how you can figure those out. And then number 4. Ask, determine the probable operating income if sales total 32,000. So of course you can work this out with the sales minus the cost, or what you can do is take the 32,000 times the $40, and they have it worked out a little bit differently in the book here. So can you punch in 32,000 times 40? Which is your unit contribution margin.
1,280,000.
So that's our overall contribution margin. And our fixed cost, remember, was 800,000 here. So if you subtract that from your contribution margin, you'll get straight to the 480 for your operating income. All right, and that's it for the Chapter 20 problems. I hope everybody's doing okay, and let me know if you have questions.